If you have $100,000 or more sitting in a 401k, an IRA, a savings account, or any mix of retirement money, the IRS just started a new rule this year that could quietly change how much of your money goes to taxes. It's not a rumor. It's not a headline someone made up to get clicks. It is a real change that took effect on January 1st, 2026. And here's the part that worries me. Most retirees have no idea it happened. Even if you're fully retired, don't click away. This first rule may not apply directly to everyone, but the next 3 updates affect millions of retirees with savings over $100,000. This isn't about losing your Social Security. It isn't about the government taking your savings away. It's about something much quieter. A shift in how certain retirement contributions and withdrawals are taxed. And if you don't understand it, you could end up paying more than you expected, without ever knowing why. Today, I'm going to walk you through exactly what changed, who it affects, and 3 other things every retiree with meaningful savings should be watching right now. Stay until the end, because the last update is the one that ties everything else together, and it's the one most retirees never think about until tax season surprises them. Before we start, welcome back to Robert Preston Updates. This channel breaks down Social Security, Medicare, the IRS, and retirement money into simple, honest information for seniors. No confusing jargon, no scare tactics, just what you need to know so you can protect what you've worked your whole life to build. If that sounds useful, consider subscribing so you don't miss future updates. Now, let's get into it. And let's start by understanding why this particular year is so different from the ones before it. For the last few years, retirement rules have been changing in pieces, a little at a time. Back in December 2022, Congress passed a large retirement law called the Secure 2.0 Act. Instead of taking effect all at once, lawmakers designed it to roll out slowly, piece by piece, over more than 10 years, all the way through 2033. Some parts started in 2023, some started in 2024, and several important parts are landing right now, in 2026. That's exactly why this year matters so much. Multiple changes are hitting retirees at the same time, and when several small rule changes happen together, they can add up to a bigger financial impact than any single one of them alone. Think of it like small leaks in a roof. One leak might not seem like much, but 3 or 4 leaks happening in the same season can do real damage if nobody notices them in time. So today, we're going to go through this roof, leak by leak. We'll start with the specific new IRS rule that changed this year, then move into 3 more updates that connect directly to it. Each one builds on the one before it. So even if the first update doesn't seem to apply to you personally, keep watching, because the pieces come together by the end, and that's when the real picture becomes clear. Let's start with the rule that changed on January 1st of this year. Here's the update. Starting January 1st, 2026, if you are 50 or older, and you earned more than $145,000 in wages the year before, any catch-up contribution you make to a 401k or similar workplace retirement plan must now go into a Roth account. That means after-tax dollars, not pre-tax dollars like before. Let me explain what that actually means in plain language, because the wording alone can sound confusing. A catch-up contribution is extra money that people age 50 and older are allowed to add to their retirement account, above the normal yearly limit. It exists because lawmakers understood that many people don't start saving seriously until later in life. So they created a way to add more money in those final working years before retirement. For years, workers could choose where that catch-up money went. They could put it into a traditional account, where it isn't taxed until they withdraw it later in retirement. Or they could put it into a Roth account, where it's taxed right now, but grows completely tax-free after that, and comes out tax-free too when they retire. Before this year, that choice was entirely up to the worker. Now, for higher-earning workers, the choice is gone. If you earned over $145,000 last year, your catch-up contributions must go into a Roth account starting this year. That means you pay the tax on that money now, in the year you earn it, instead of decades later when you're retired and possibly in a lower tax bracket. Now, I know what some of you might be thinking. I'm already retired. I'm not contributing to a 401k anymore. Does this even apply to me? For some of you, no. It doesn't apply directly. This rule targets people who are still working and still earning income above that threshold. But here's why I'm still telling every retiree with $100,000 or more in savings about it. This rule is a signal. It shows the direction the IRS is moving. More and more retirement money is being pushed toward Roth treatment, where taxes get paid earlier instead of later. And if you have a spouse who is still working, an adult child helping you understand your own accounts, or if you yourself picked up part-time work in retirement, this rule could reach you sooner than you think. Let me tell you about a retiree named Carol. Carol officially retired from her main career at 66, but she kept a part-time consulting job on the side, mostly because she enjoyed staying active and connected to her old industry. Between her consulting income and a small pension, she crossed the $145,000 mark last year without even realizing it. She wasn't trying to earn that much. It just happened, one contract at a time. This year, when Carol went to make her usual catch-up contribution to her small business retirement plan, her account provider told her something new. The contribution now had to go into a Roth account instead of her traditional one. Carol wasn't upset. She just didn't know. Nobody had explained the rule to her in advance. And that's exactly the point I want you to remember. Rules like this don't send you a personal letter explaining what changed. The IRS doesn't call you. Your bank doesn't always flag it clearly. You have to know to ask. If you or your spouse are still earning income in retirement, even part-time, it is worth checking with your plan provider or a tax professional to see if this new Roth requirement applies to you this year. A short conversation now can prevent confusion later. Now, here's where it gets more important for every retiree, whether you're still working or not, because this new Roth rule connects to a much bigger pattern in how the IRS treats retirement withdrawals overall. And that pattern is the second update you need to understand. But here's something almost nobody tells retirees. Let's talk about required minimum distributions, often called RMDs for short. If you have a traditional IRA or a traditional 401k, the IRS requires you to start withdrawing money from that account once you reach a certain age. As of 2026, that age is still 73 for most retirees. That part has not changed this year. But here's what many retirees don't realize. The penalty for missing an RMD changed a couple years ago, and most people still don't know the new numbers. It used to be a massive 50% penalty if you missed a required withdrawal. Half of the money, gone, simply for forgetting. That penalty has since been reduced to 25%. And if you catch the mistake and correct it quickly, within a certain window, it can drop even further, down to 10%. That's a meaningful improvement compared to the old rule. But let's be honest, 10% to 25% of a missed withdrawal is still real money. For someone who was supposed to withdraw $12,000 and forgot, that penalty could be anywhere from $1,200 to $3,000, just for missing a deadline. Here's a story that shows exactly how this catches people off guard. A retiree named Walter turned 73 last year. He knew he had to start taking withdrawals from his IRA, so he set up what he believed was an automatic withdrawal through his bank. What he didn't realize was that his bank had only set up the automatic transfer for one of his accounts, while he actually had two separate IRAs left over from two different jobs earlier in his career. The second account sat completely untouched all year long. Nobody withdrew a dollar from it. When his accountant reviewed his taxes the following spring, they caught the missed RMD just before the deadline to correct it. Walter avoided the higher penalty, but only because someone else caught it in time. Many retirees are not that lucky. They find out months later, after the deadline has already passed. The lesson here isn't to panic about RMDs. It's to make sure you know exactly which accounts you own, which ones require withdrawals, and whether those withdrawals are actually happening on schedule every single year. This becomes even more important if you have several old accounts from past jobs, because it's incredibly easy to forget about one, especially if the statements stopped coming by mail years ago and now only show up buried in an email inbox. While we're on the topic of retirement account rules, there are two smaller changes worth knowing, because they show how much flexibility has actually improved for savers in the right situation. First, if you're between the ages of 60 and 63, there's now what's sometimes called a super catch-up contribution. It allows you to set aside even more money than the standard catch-up amount, somewhere in the range of $11,000 extra, depending on how the limit is adjusted for the year. Second, Roth accounts inside employer plans, like a Roth 401k, no longer require you to take any withdrawals during your lifetime at all. That's a change from a few years ago, and it removes one more layer of required paperwork and tax planning for people who saved in a Roth 401k. These two changes aren't warnings, they're actually good news. But almost nobody hears about them, because the news usually focuses on penalties, not opportunities. Now here's where Update 1 and Update 2 come together, and I want you to really picture this for a moment. The IRS is clearly shifting more and more retirement money toward Roth accounts, where taxes get paid earlier, in the years leading up to retirement. At the same time, the IRS is still requiring traditional account holders to withdraw money on a strict yearly schedule once they hit 73, with real financial penalties for missing it. Put those two things together, and you can see the bigger picture forming. The IRS wants its tax revenue, and it wants that revenue on a predictable schedule, whether that money comes from Roth contributions made today or required withdrawals taken later. Understanding that pattern helps you plan your own withdrawals with intention, instead of being surprised by them year after year. That brings us to the third update, and this is the one that ties everything together. Because even if you handle your RMDs perfectly, and you're not personally affected by the new Roth catch-up rule, there's still one more thing that can quietly increase your tax bill without you ever making an obvious mistake. Here's something most retirees never hear, clearly explained. Your retirement accounts do not exist in isolation, separate from the rest of your finances. A withdrawal from your IRA or 401k doesn't just show up as its own separate little number on your tax return, sitting off to the side. It gets added to your total income for the year, right alongside your Social Security, your pension, and anything else you earned. And once your total income changes, it can affect other things too, things you might not immediately connect to that one withdrawal. Two things in particular deserve your close attention. First, Social Security taxation. Depending on your total income for the year, a portion of your Social Security benefit can become taxable. Many retirees are genuinely surprised to learn that up to 85% of their Social Security benefit can be counted as taxable income if their total income crosses certain limits set by the IRS. A large withdrawal from a retirement account in one particular year can push you over that line, even if you never thought of that withdrawal as a major financial event. To you, it might have felt like a simple decision, moving money from one place to another. To the IRS, it looked like new income. Second, Medicare premiums. If your income crosses certain thresholds, Medicare can charge you a higher monthly premium for Part B and for Part D. This is called an income-related monthly adjustment amount, sometimes shortened to IRMA. Many retirees don't realize that Medicare looks back 2 full years at your tax return to decide your premium for the current year. That means a large withdrawal you make today could raise your Medicare costs 2 years from now, long after you've completely forgotten about the withdrawal that actually caused it. It can feel almost impossible to trace the cause, because so much time has passed in between. Let me give you one more example to make this connection really click. A retired couple, David and Susan, decided to withdraw a larger amount from their IRA one particular year to help pay for an unexpected home repair after a storm. It felt like a simple, one-time decision, the kind anyone might make without a second thought. 2 years later, they opened their Medicare premium notice in the mail and saw their monthly cost had gone up significantly, more than either of them expected. At first, they assumed it was a mistake, maybe a billing error. It wasn't. That one larger withdrawal from 2 years earlier had pushed their total income over a specific threshold, and Medicare adjusted their premiums accordingly, exactly as the rule required. Nobody explained that connection to them in advance. There was no warning letter before the withdrawal. They only found out after the fact, when it was already too late to plan around it. This is exactly why understanding your full financial picture matters more than focusing on any single account by itself. It's not just about how much you have saved across all your accounts combined. It's about how a withdrawal from one account can quietly ripple outward and affect your Social Security taxation, your Medicare premiums, and your overall tax bill, sometimes years later, in ways that are easy to miss until the bill actually arrives. Now, let's talk about the fourth and final update, because this one is a little different from the others. This one isn't a warning. It's actually something that could work in your favor if you understand it correctly. This year, the standard deduction increased again, and for many retirees, it's larger than it's ever been. For married couples filing jointly, the standard deduction for this tax year is around $32,200. That's the amount of income you can subtract before the IRS even starts calculating what you owe. A higher standard deduction means more of your income, including part of your Social Security and part of your retirement withdrawals, can potentially be shielded from taxation before you owe a single dollar. Why does this matter for our conversation today? Because it changes the math slightly on everything we just talked about. If your standard deduction is higher this year, you may have a little more room to take a withdrawal or convert some traditional retirement money into a Roth account before you cross into a higher tax bracket or trigger those Social Security and Medicare thresholds we just discussed. This is exactly the kind of detail that a tax professional can help you calculate precisely for your own situation, because your filing status, your state, and your total income all affect the exact numbers that apply to you. I bring this up because I don't want today's video to feel like nothing but bad news. The truth is, some of these changes create real opportunities for retirees who take the time to understand them. The IRS isn't only taking, in some cases, through a higher standard deduction or a properly timed Roth conversion, you can actually keep more of your own money than you would have a few years ago. But that only happens if you know these details exist in the first place. So let's bring all four updates together and turn them into something you can actually use this week. But before you assume all these changes are bad news, here's one update that could actually save you money. First, if you or your spouse are still earning income in retirement, check whether your wages crossed $145,000 last year. If they did, confirm with your retirement plan provider whether your catch-up contributions are now required to go into a Roth account this year, and plan your budget around paying that tax now instead of later. Second, make a complete list of every retirement account you own, including old 401k accounts from jobs you left years ago. For each one, confirm whether it requires an annual withdrawal, and confirm that withdrawal is actually scheduled and actually happening, not just assumed to be happening automatically. Third, before making any large withdrawal from a retirement account, think beyond just this year's tax bill. Ask yourself how that withdrawal might affect your Social Security taxation or your Medicare premiums 2 years from now. A quick conversation with a tax professional before a large withdrawal, not after, can prevent a costly surprise later. Fourth, ask a tax professional about this year's higher standard deduction and how it applies to your specific income. There may be room to make a smart move, like a partial Roth conversion that fits comfortably within your current tax bracket without pushing you into a higher one. Fifth, review your full financial picture once a year, not just your account balances one at a time. Look at how your accounts work together as a whole: Social Security, pensions, retirement withdrawals, and any part-time income, all combine to determine your total tax situation, and none of them should be reviewed completely on their own. None of these 5 steps require you to make a major decision today. They simply require you to check, to ask, and to understand what's already happening with your money behind the scenes. Let's review everything we covered today, because there was a lot of ground to walk through together. Update 1. Starting this year, higher earning workers age 50 and older must direct their catch-up retirement contributions into Roth accounts instead of traditional ones, meaning taxes get paid now instead of later. Update 2. Required withdrawals still begin at age 73. And while the penalty for missing them has been reduced from the old 50% down to 25%, or even 10% if corrected quickly, it's still meaningful money if you forget, especially with an old account you might not remember you own. Update 3. Withdrawals from your retirement accounts don't exist alone in a vacuum. They can affect your Social Security taxation and your Medicare premiums, sometimes years down the road, long after the original withdrawal is a distant memory. And Update 4. This year's higher standard deduction may give you a little more breathing room to make smart moves if you take the time to ask a professional about your specific numbers. None of these updates are designed to scare you. They're designed to help you avoid the kind of surprise that Carol, Walter, and David and Susan all experienced in their own ways. Small oversights, or simple decisions made without the full picture, that led to unexpected tax bills or higher costs, simply because nobody explained the connections in advance. That's the part that really bothers me about how these rules get communicated, or rather, how they don't get communicated at all. The government doesn't call you. The government doesn't send a friendly reminder letter before your Medicare premium goes up. You are expected to already know, and that's simply not realistic for most people, especially when the rules keep changing every single year. If there's one thing I hope you take away from today's video, it's this. Retirement planning isn't just about how much you've saved over the years. It's about understanding how all the pieces fit together. Your savings, your withdrawals, your Social Security, and your Medicare costs, as one connected system instead of separate boxes. The IRS rules will keep changing over the coming years as the rest of the Secure 2.0 Act continues rolling out all the way through 2033. Staying informed a little at a time, video by video, update by update, is much easier than trying to catch up all at once after a costly mistake has already happened. If today's video helped you understand these updates a little better, please take a moment to share it with someone who has retirement savings. A parent, a sibling, a friend from church, anyone who could genuinely benefit from knowing this before tax season arrives and catches them off guard. And if you want more simple, honest updates about Social Security, Medicare, the IRS, and retirement money, make sure you're subscribed to Robert Preston Updates and that your notification bell is turned on so you never miss the next one. I'd also love to hear from you. Did you know about this new Roth catch-up rule before today? Or has a retirement withdrawal ever affected your Medicare premium or your Social Security taxes without you expecting it? Share your experience in the comments below. Your story might help another retiree avoid the exact same surprise. Thank you so much for spending your time with me today. Stay informed, stay prepared, and I'll see you in the next video.